How do thinly traded commodity ETFs deal with low liquidity? Imagine trying to buy or sell a rare collectible at a busy market versus a quiet one. That's similar to what happens with thinly traded commodity exchange-traded funds. These funds often don't have high daily trading volumes, but they still manage to function smoothly. How do they do that? The secret lies in their special creation and redemption process involving authorized participants and market makers. Authorized participants are large broker-dealers who can create new ETF shares or redeem existing ones in big blocks called creation or redemption units, usually around 50,000 shares. When more investors want to buy the ETF, these authorized participants gather the underlying commodities or futures contracts and deliver them to the ETF sponsor in exchange for new shares. These shares are then sold on the exchange. When investors want to sell, authorized participants buy back the ETF shares and return them to the sponsor in exchange for the underlying assets. This process helps keep the ETF's share supply flexible and responsive, even if the trading volume on the exchange is low. The liquidity of the ETF also depends on how liquid its underlying assets are. If the commodities or futures contracts are easy to buy and sell, authorized participants can quickly create or redeem shares, keeping the ETF's price close to its net asset value. Market makers also play a big role. They are firms that continuously quote buy and sell prices for the ETF, providing liquidity to investors. They hold inventories of ETF shares and use hedging strategies to manage their risk, sometimes using proxy hedges if direct hedging is difficult. This activity helps narrow bid-ask spreads, making trading smoother even when trading volume is low. However, thinly traded commodity ETFs often have wider bid-ask spreads, especially during volatile markets. This can increase trading costs for investors. To avoid this, investors should consider using limit orders instead of market orders and avoid trading during the first and last half hour of the trading day when spreads tend to widen. It's also wise to look at the underlying commodity assets' liquidity and the presence of active market makers. Larger assets under management and higher average daily trading volumes usually mean better liquidity, but even smaller ETFs can maintain liquidity through the creation and redemption process. Keep in mind, low liquidity can sometimes cause higher tracking error, meaning the ETF's performance might not perfectly match the underlying commodities. Choosing physically backed ETFs, which hold actual futures or assets, often results in lower tracking errors compared to synthetic ETFs that use derivatives. In short, thinly traded commodity exchange-traded funds handle low liquidity through their unique creation and redemption system supported by market makers. This multi-layered approach helps investors buy and sell shares even when trading volumes are low. But paying attention to bid-ask spreads and tracking error is still important for making smart investment choices.